Well, good day, ladies and gentlemen, and thank you once again for joining the Caledonia Q2 and first half results presentation for 2016. As usual, today I'm joined by Mark Learmonth, our CFO, and Donna Roots, the COO, and we're very pleased to present these results to you. Just as an introduction, I'd like to emphasize that the good results that Mark will take you through in more detail are just evidence of a plan that is coming together, this plan that started in November 2014, and this is now just the culmination of a lot of hard work that took place last year, and we're starting to see the fruits of that hard work in terms of the increase in production tonnage, the improvement in the grade, and obviously then the output of extra gold ounces. This is what we expected. This is what we had indicated to the market we would be doing. And therefore, it's very pleasing to be able to say it is happening. And we therefore expect, because the foundations have been laid, that the outcome for Q3 and Q4 is very much on track for us to achieve our target of 50,000 ounces for 2016. Everything being equal, we are looking forward to a good 2016 in total, and the Blanket mine continues to deliver very good results. The management team is doing an excellent job, and I think once you've got greater insight as to the Q2, you will hopefully build up a level of confidence that this is going to roll out into a very, very successful year for you as shareholders. So without any further ado, let me hand over to Mark and let him take you through in detail the results as achieved. So thank you once again.
Thank you, Steve. Well, turning to page 3, just to give you an overview of the profit and loss, what you see here is the summary profit and loss account for the 3 months to 30th of June and for the 6 months to 30th of June. And all I'll do is I'll just draw your attention to 4 or 5 items on the schedule. The first is clearly that the top line revenue has increased in the quarter and the half year. So in the quarter it's gone from 12.2 in the comparative quarter of 2015 up to 15.7 million. And it's gone from $25.1 million in the first half of 2015 to 29.1 in the first half of 2016. I'll explain why that's happened in due course. Higher revenue has flowed through to a significant improvement in EBITDA. So EBITDA improved from $2.2 million in the 3 months to June 2015. It's gone up to $5 million in the 3 months to June 2016. And for the and looking at the first half, it was $8.3 million compared to $5.2. As we go down the profit and loss account, you can see that we've booked a profit on the sale of some treasury bills, which again I'll talk about in a bit more detail later on. $3.2 million before tax was realised in the quarter. And then looking down at the profit attributable to Caledonia shareholders. That has increased very dramatically from only $300,000 in 2015 to 3.6 million in 2016, and looking half on half, it increased from 1.5 million to 4.2 million. And turning to earnings per share increased from 0.4 cents in the 3 months to June 2015 to 6.7 cents in the 3 months to the end of June 2016, and on a half-year basis it increased from 2.7 to 7.7 cents a share. Turning to production revenues and looking at the effects of changes in production and the gold price. The first thing is tonnes milled. It's worth noting that the tonnes milled in the quarter, just over 120,000 tonnes milled. That was a record from underground activity, and that really reflects the successful implementation of the tramming loop, which we finished in June, July last year, and just has allowed us to move more material. Also, in the quarter, you can see that the grades improved. It went from 3.35 grams a tonne to 3.47, and that's as planned, and largely reflects the the commencement of production from below 750 metres. So now that we've got the decline completed and the number 6 winds completed, in the quarter we were able to add about 8,500 tonnes of material which was mined from below 750 metres. That typically tends to be a higher grade. And so as we migrate the mine from operating above 750 metres to below 750 metres, we do expect that grade to recover further from about 3.47 up to 4 grams a tonne over the next few years. The only slight negative in the production, and it's not a very big negative, is the average recovery, which fell from 93.3% to 93.1%, and that largely reflects the fact that we've got an oxygen plant, a plant that generates oxygen immediately next door to the metallurgical plant. That bubbles oxygen through the CIL process, which tends to increase your recovery. That oxygen plant is now extremely old and has been unreliable for quite some time. Over the last few quarters, we've examined and evaluated other ways of getting oxygen and putting it through the plant. We've now decided that we need to build a new oxygen plant. We have that on order. It's being constructed and manufactured in Germany, and over the next few quarters, that will then be delivered to the mine and will be installed. And we'd expect then the recovery to return to about 93.5% and eventually reach 94% as we operate at the higher grades from 2018 onwards. So gold production in terms of ounces was just over 12,500 ounces for the quarter, which was a few hundred ounces ahead of plan, so very much where we expected it to be. The average realised gold price clearly reflects the improvement in the world gold price, and so we realised a gold price of just over $1,252 an ounce, and that's after the 1.25% early settlement discount, which we paid to Fidelity Printers and Refiners, who refine our gold for us in Zimbabwe. So all of that contributed to a 28% increase in revenues from 12.2 million to 15.7. Turning to page 5, before we get into the detail of the numbers, let's just quickly talk about the dividend, because it is important to shareholders, and management recognises that, and management strives to make sure that the dividend is sustainable, and we have the flexibility to increase it if necessary. What we see on page 5 is by no means an exhaustive list of gold producers who pay dividends, but it shows the dividend yield for Caledonia compared to some of the other gold producers who pay a dividend. You can see that, notwithstanding the fact that we've increased our dividend, we increased the dividend by 22% from 1.125 cents a quarter to 1.375 cents a quarter. Our dividend yield at 4.8% is still significantly higher than the dividend yields for many other gold producers, and we would hope that over time, as investors become more comfortable with the risks at Caledonia itself, at the Blanket mine, and more generically become more comfortable with Zimbabwe as an investment destination, we would hope that dividend yield could fall further, which would imply a further significant increase in the share price. Looking more closely on slide 6 at gold production, what you see here is the usual two graphs that we use. The top graph shows quarterly gold production. The bottom graph breaks that down in terms of tonnes milled, which is the bar. The green line is the achieved grade, and the red line is the recovery. And so you can see quite clearly from the top graph that we're now in a sort of a sustained upswing in quarterly production. The slight dip that you'll see in production in quarter 1 of 2016, that just reflects the normal operating environment in quarter 1, which typically gets affected by New Year holidays, and Easter in this year was also in the first quarter, and clearly they're holidays and they do adversely affect production. But generally, we are seeing now an upswing in quarterly production, and we'd expect that to be sustained through the rest of this year into 2017, into 2018 and beyond. On the bottom graph, quite clearly you can see the spike in the tonnes milled in the quarter at just over 120,000 tonnes, as for reasons I've just explained. Turning to page 7, we have some information here on the resource upgrade, which we announced recently. It's worth noting that over the past 18 months or so, we've significantly increased our commitment to exploration and resource development at Blanket. So we've bought and commissioned a suite of new drilling machines, which are now successfully operating. So we've pretty much tripled the amount of meterage drilled each month, and that's now beginning to bear fruit in terms of our ability to announce progressive increases and improvements in upgrades to the resource statement. And so what you see here on the left-hand side is you can see the total resource statement split between measured and indicated, of about 4.8 million tonnes at a grade of 4.23, so that gives you 660,000 ounces of contained gold. Then also inferred resource of about 3.8 million, typically at a higher grade. And as I mentioned before, the grades do tend to be higher as we get deeper into the mine, and the inferred material is pretty much all below 750 metres. So that's an average grade of just over 5 grams a tonne, giving another 622,000 ounces of gold contained. We would expect to announce further resource upgrades as we continue with the increased resource development work. Turning to slide number 8, just a little bit more detail on the production costs. So in the first half, gold produced was about 15% higher than in the comparable half of 2015. The on-mine cost fell by 8% from $718 an ounce to $658 an ounce, and that comprises labour, on-mine labour, consumables, electricity and security and other on-mine costs. At the top level, the all-in sustaining cost, which includes G&A and also includes sustaining capex, is pleasing to see that the all-in sustaining cost has now once again gone below $1,000 an ounce. It's now $943 an ounce, and we would expect that cost to come down further as we continue to increase production. And that means that the fixed costs, 65% of the costs at Blanket are fixed, and virtually all the costs at Caledonia, the top company level, are fixed. So as we increase production, we do expect that all-in sustaining cost per ounce to fall further quarter on quarter. Breaking down the costs still further, you can see that the cost per tonne milled, we've reduced that from $73 a tonne to $69 a tonne. And so that means that every tonne of material we're moving underground, we're doing it more cheaply. And that also means that as we tend to increase, as the grade increases going forwards and our recovery increases, that should further enhance the ability to reduce the cost per ounce. The main components of on-mine costs were salaries and wages. So 6.3 million of salaries and wages at the mine level in the first half compared to 5.8 in the comparable half of 2015. The amount that we paid in 2016 includes a very significant on-mine production bonus, which relates to their performance last year. And you can see that consumables has gone up from 7.5 million to 8 million. Approximately half of those consumable costs are fixed. On-mine administration costs, about 1.3 million, have remained stable. So in general, we are seeing a very stable, benign cost environment at the mine in Zimbabwe. And again, because the high fixed component, that means that as we increase production, we do expect those on-mine costs and the all-in sustaining cost to continue to move downward. Turning to slide 9. Slide 9 breaks down the general and administrative costs which are incurred by Caledonia. So these are above the mine level. The main components of these costs are, broadly speaking, employee costs. Here in Johannesburg, we have a very significant team of technical specialists led by Dana, the Chief Operating Officer, who provide constant assistance, support and advice to the mine, particularly in terms of implementing the Central Shaft project. And so you can see that number has broadly has come down slightly from about 1.2 million to 1.1 million. The other main component is really a combination of professional consulting fees and legal fees and disbursements. Within the total charge for half one, which is nearly $1 million, approximately $300,000 of that related to the migration when we moved the company out of Canada to Jersey. That was a very complex legal transaction, but we've seen the benefits of that already in terms of reducing the company's tax exposure. And from a shareholder perspective, it means that the Caledonia shares no longer attract Canadian withholding tax, and that contributed to the increase in the share price that we've seen over the course of the year. Also, it's worth noting that even though we're a relatively simple operation with just one gold mine in Zimbabwe, we do operate in multiple jurisdictions. We've got operations in Zimbabwe, South Africa, and we have to make sure that we comply, or we don't fall foul of some quite complex and some quite aggressive tax regulations, particularly relating to transfer pricing. And so I'm afraid it's just going to be a recurring feature of our structure that we do have to continue to incur significant professional consulting fees and legal fees to make sure that we're fully in compliance with all of the regulatory conditions in the various operations in which we're represented. The only other significant thing in this schedule is that you can see that in the first half of 2016 there's no cost associated with Zambia, whereas in the previous first half year of 2015 we incurred about $668,000 there. Zambia has been closed down, and we no longer have any operations in Zambia. Turning to page 10. This shows you the quarterly adjusted earnings per share. The adjusted earnings per share, that excludes any foreign exchange gains or losses, also excludes any unusual items. So in this quarter, it means that we've excluded the profit on the sale of the treasury bills, because clearly whilst it was very welcome, we don't expect that to be a recurring feature. It also excludes the non-cash element relating to deferred tax. And deferred tax just simply recognises the difference between the accounting treatment of capital investment and the tax treatment of capital investment. And in Zimbabwe, luckily, we're in an environment where 100% of our capital expenditure can be offset against your taxable profits, whereas clearly for accounting purposes, that is recouped over a period of time through depreciation. And again, I think you can see quite clearly we've now started what I expect to be a significant and sustained upswing in quarterly earnings per share from a low point in quarter 3 of 2015. So we do expect to see quarter-on-quarter increases in earnings per share as we continue to increase production, and our average cost per ounce continues to fall. Turning to perhaps what I regard as the most important slide, which is slide number 11, cash flow. I think what's nice to see here is this strong improvement in cash from operating activities. Clearly, we're continuing to spend a lot of money at the mine. So we spent about $8.2 million in the first half compared to 5.8. The capital expenditure is exactly on plan. As our cash flow position improves, and as Blanket's cash generation improves, we have taken the decision to bring forwards some capital expenditure which was planned for later quarters, and that's really to make sure that we don't end up in a position where materials either get delayed at the border or delays in commissioning. And so it's really we're doing that to make sure that we're safeguarding the future projected increase in production. But very nice to see the improvement in cash from operating activities from 3.1 million in the first half of 2015 to nearly 9 million in the first half of 2016. Clearly the dividend, as we continue to pay dividends, the dividends actually here seems to have fallen from about 1.3 million to 1.1. That's because in half one of 2015 our dividends were still denominated in Canadian dollars. Now we've now established a US dollar dividend, which we increased earlier on this year to from 1.1 1/8 cents to 1 3/8 cents. So nice to see that the cash has now once again started to improve. $10.5 million of cash, no debt at the end of the quarter, and we expect that to continue to improve quite strongly as the year progresses. Turning to the balance sheet, there's really very little to say in terms of the balance sheet. Clearly the fixed assets continue to increase as we continue to invest in the mine. Working capital remains stable. And there's really not much more to say. We do have an overdraft facility in Zimbabwe, a $5 million overdraft facility, which we're busy converting part of that into a term loan. So we're looking at a $3 million term loan in Zimbabwe and a $2 million overdraft facility, and that's just simply to give us greater flexibility to use to use the debt facility in Zimbabwe for slightly longer term purposes. I mean, I think the balance sheet remains strong, and we intend to keep it that way. So with that, I'd turn to the outlook and ask Steve to talk about where this business is going over the next sort of few quarters.
Thank you, Mark. As you can see, there's a lot of good news in the results for the quarter and the half year. So what I'd like to do is try and pull it together in terms of looking at the outlook, and then ask Dana just to give us a wrap up on the projects that he has got running at the mine in terms of the central shaft, the decline, and general production matters. So really, just from an outlook point of view, as I said right at the beginning, these good results are a factor of the revised investment plan, and this just continues to be the absolute focus of the management team here in Johannesburg and at the mine. The results are going to be that costs will continue to decline as more and more ounces are produced at Blanket Mine. And that gives us the ability to weather a storm if there is any decline in the gold price. Costs are what we can control, and it's very much what we focus on. We continue to provide the guidance of 50,000 ounces for 2016, and so Q3 and Q4 should demonstrate to you a continued increase in production and successes at the mine. We have got a conservative approach to cash management. We started this project with a very much larger cash balance, but that was built up for a purpose. We now have a return to positive cash flow in terms of the mine and the capital expenditure being spent, which results in a very pleasing situation that Blanket Mine has resumed the payment of dividends. And that will flow through to the indigenous shareholders, and obviously it will flow through to Caledonia in terms of our share of dividend and our share of repayment of the facilitation loans. So all in all, as we know, cash is king in businesses, and we are very pleased that Blanket continues to be a very cash generative business. And we look forward to the next couple of quarters as this business continues to grow. So I'd like to ask Dana now just to run through some of the technical projects that he's got in play at the moment, and just give you a sense as to his impression of the balance of the year.
Good morning. Thanks for that, Steve. Yes, we've got a couple of projects going, and the main reason for these projects is to get the right infrastructure in place to be able to get us into a mode that we can handle all the tons that we need to get to 80,000 ounces a year. The number one project that we're busy with is the central shaft. The central shaft is going well. We're into permanent sink mode. We started with a jumbo drill rig, and we're drilling 3-meter rounds a day. We sorted out the teething problems, and we started to get, for the last month, our daily blast, and we're currently down 230 meters. At this rate, we should be about halfway by the end of this year, and then we should be able to complete a sink down to 1,080 meters by the end of next year, or just early 2018, and then with the completion of the central shaft still on schedule to be completed by mid-2018. The other very important project we have is the decline number 1, which is going down below 750 meters, which is at the AR South ore body. This is our main ore body with the highest grade. Just to remind you, last year we did 42,000 ounces, and the build-up this year is to 50,000 ounces. And the extra production that we will get is the base above 750, which will give us again 42,000 ounces, and then production below 750, which will come from the AR South ore body below 750 and also the 6 winds that we completed. And that will give us production from the blanket ore body below 750 level. Both these shafts, the one the decline and the 6 winds, has been completed, and we are getting production from these areas. We saw the build-up in the second quarter that came from the extra production below 750, and that will continue through to the end of the year. We need to do about 1,550 tons a day to achieve our target of 50,000 ounces for this year. We are at that level currently. We are achieving those targets, and for the rest of the year, it's just doing more of the same. The infrastructure is in place, and at this rate, if nothing seriously happens to the grade, which we don't foresee, there is no reason why we cannot achieve our 50,000 ounces for the year. Another project that we're busy with is we need to upgrade the plant. Currently, the milling capacity or the grinding capacity at the plant is 1,500 tons a day. So we're at maximum as far as that is concerned. We're busy installing a new rod mill that will enable us to get to the 1,800 tons a day that we need for full production. That rod mill will be completed and installed by the end of September, which will put us in good stead for the rest of the build-up as far as the production build-up is concerned. Early next year, we will also install a new regrind mill, and that will complete the grinding part of the plant as far as full production is concerned.
Thanks, Donna. It's always good to hear that the operational things are going according to plan, and we look forward to good quarters in the future. So once again, thank you for joining this presentation. We are well into the third quarter already. We're looking forward to presenting third quarter results to you, and we thank you for your time today, and look forward to having a chat again in the near future. Thanks again, and bye-bye.